All right, listen up, ETFs. Everyone's talking about them. Are they some kind of magical money tree? Not really, but they are pretty handy. An ETF, or exchange-traded fund, is like a big basket of different investments. Think of it as a variety pack of crisps, but instead of crisps, it's stocks and bonds. This makes them less risky than putting all your money in just one company. They are quite popular, these ETFs. Why? Because they offer a simple and affordable way to invest in the stock market. And who doesn't like simple and affordable? So, are you ready to dive into the world of ETFs? Good, let's go. Imagine a big basket, not a picnic basket, but a basket big enough to hold, say, 100 different companies. That's kind of what an ETF is like. It holds a collection of assets, usually stocks, all bundled together. These baskets, or ETFs, can be based on different things. Some track specific indexes like the S&P 500. That's the 500 biggest companies in America. Others focus on specific sectors, like technology or healthcare. So instead of buying shares of individual companies, you buy shares of an ETF, which gives you a tiny piece of all the companies in that basket. Pretty neat, right? Now here's the thing about ETFs. They're traded on stock exchanges just like individual stocks. That means you can buy and sell them throughout the trading day, just like you would with regular stocks. The price of an ETF goes up and down throughout the day, depending on the value of the underlying assets in the basket. So if the companies in the ETF are doing well, the price of the ETF goes up. If they're not, well, you get the idea. And the best part, you don't need a fancy broker to buy ETFs. Most online brokerage accounts will do. Okay, so ETFs are like baskets of stocks. They allow you to invest in a variety of companies all at once, spreading out your risk. But how do they compare to other investment options like individual stocks, bonds, or even those mysterious mutual funds? Each has its own unique characteristics and benefits. Well, stocks are like buying a single crisp from the variety pack. When you buy a stock, you're purchasing a small piece of a company. You could get lucky and pick the tastiest one, or you could end up with the flavor nobody likes. The value of a single stock can be very volatile, going up and down based on the company's performance and market conditions. Bonds are like lending money to the government or a company. When you buy a bond, you're essentially giving a loan to the issuer in exchange for regular interest payments. You get paid interest, but the returns are usually lower than stocks. Bonds are generally considered safer investments, but they come with their own risks, such as interest rate changes and the credit worthiness of the issuer. Mutual funds are similar to ETFs in that they also hold a basket of assets. They pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. But they're like the fancy, expensive, crisp assortment, with higher fees and less flexibility. Mutual funds are actively managed, meaning a professional manager makes decisions about how to invest the fund's money. ETFs, on the other hand, are like the value pack of crisps. They offer a similar level of diversification, but at a lower cost because they are usually passively managed, tracking an index rather than trying to beat the market. They offer diversification at a lower cost. This makes ETFs an attractive option for many investors looking to balance risk and return without paying high fees. Section 5, the good stuff, why ETFs are pretty neat. So, we've established that ETFs are like the value pack of the investment world. They offer a convenient way to invest in a broad range of assets without having to buy each one individually. But what are the actual benefits of investing in them? Firstly, diversification. Remember the basket? It's a classic analogy, but it holds true. With ETFs, you're not putting all your eggs in one basket. Instead, you're spreading your investments across a variety of companies and sectors. This diversification helps to reduce your risk. If one company or sector underperforms, others in your ETF might do well, balancing out your overall performance. Secondly, cost efficiency. ETFs generally have lower fees compared to mutual funds. This is because they are passively managed, meaning they track an index rather than having a team of managers making decisions. Lower fees mean more of your money stays invested, which can compound over time, leading to greater returns. That means more money in your pocket. And who doesn't like that? And lastly, flexibility. ETFs can be bought and sold throughout the trading day, just like stocks. This intraday trading capability makes them a more liquid investment option compared to mutual funds, which can only be traded at the end of the day. This flexibility allows investors to react quickly to market changes. So, whether you're a seasoned investor or just starting out, ETFs offer a range of benefits that make them a pretty neat option for building a diversified, cost-efficient, and flexible investment portfolio. Section 6. Hold your horses, ETFs aren't perfect. Now, before you go all in on ETFs, let's be realistic. They're not a guaranteed path to riches, and there are some risks involved. Just like any investment, ETFs can lose value. If the market takes a downturn, the value of your ETF will likely go down too. Remember, diversification helps reduce risk, but it doesn't eliminate it entirely. Also, while ETFs generally have lower fees than mutual funds, they're not free. You'll still need to pay trading fees and expense ratios. And finally, with so many ETFs available, choosing the right ones for your investment goals can be overwhelming. Section 7, ETFs for beginners, a good place to start. So, are ETFs a good choice for beginner investors? The short answer is, they can be. But like anything else, it's important to do your research and understand what you're getting into. ETFs offer a relatively simple and affordable way to invest in a diversified portfolio of assets. And because they're traded on stock exchanges, they offer more flexibility compared to other investment options. However, it's crucial to remember that ETFs are not risk-free. It's essential to understand the potential downsides and choose ETFs that align with your investment goals and risk tolerance. Section 8. Different flavors of ETFs, there's one for everyone. Just like there are countless varieties of crisps, the world of ETFs offers a flavor for every investor. You've got your plain vanilla index ETFs that track the overall market. Then, there are sector-specific ETFs that focus on industries like technology, healthcare, or energy. Feeling adventurous? Try emerging market ETFs that invest in companies in developing countries. And if you're concerned about the environment, there are even ESG ETFs that focus on companies with strong environmental, social, and governance practices. The point is, there's an ETF out there for everyone. The trick is finding the ones that suit your taste. Section 9. Picking your ETF team. Do your homework. Choosing the right ETFs is like assembling a team of superheroes. You want a diverse group with different strengths to tackle any challenge. First, determine your investment goals. Are you saving for retirement? Buying a house? Once you know your goals, you can choose ETFs that align with your time horizon and risk tolerance. Next, research different ETFs. Look at their holdings, expense ratios, and past performance. Don't just go for the ETFs with the flashiest names. Read the fine print and understand what you're investing in. Remember, investing is a marathon, not a sprint. Choose ETFs that you believe in for the long haul. Section 10. The ETF game plan, not a get-rich-quick scheme. Investing in ETFs isn't about getting rich quick. It's a strategy that requires patience, discipline, and a long-term perspective. It's about building wealth gradually over time, much like nurturing a plant from a tiny seedling into a robust tree. It's like growing a tree. You don't expect it to become a towering oak overnight. You plant the seed, water it regularly, and patiently wait for it to grow. Consistency is key. Start by investing regularly, even if it's a small amount. Over time, these small contributions can add up significantly. Remember the power of compound interest. It's the principle where your earnings generate their own earnings. The earlier you start, the more time your money has to grow. Time is one of the most powerful tools in investing. Don't panic sell when the market goes down. Market fluctuations are normal and should be expected. Remember, investing is a long-term game. It's about staying the course and not getting swayed by short-term volatility. Ride out the lows and enjoy the highs. The market will have its ups and downs, but over time, it tends to go up. And most importantly, don't put all your eggs in one basket. Diversification is crucial to managing risk. Diversify your investments across different asset classes and ETFs to reduce risk. This way, if one investment underperforms, others can help balance it out. Consult with a financial advisor to create a diversified portfolio that aligns with your financial goals and risk tolerance. Stay informed, stay patient, and stay committed to your long-term investment strategy. Over time, your diligence will pay off. Section 11. The wrap-up ETFs, your new best friends. So, there you have it. ETFs, the value pack of the investment world. They offer diversification, cost efficiency, and flexibility, making them a compelling option for both beginner and experienced investors. But remember, ETFs are not without risks. It's crucial to do your research, choose wisely, and invest for the long term. Now, if you'll excuse me, all this talk about ETFs has made me hungry. Time for a variety pack of crisps.